Inflation is a term used to describe the general increase in prices of goods and services in an economy over time. It is usually measured by calculating the percentage change in the Consumer Price Index, CPI, which is a basket of goods and services consumed by the average consumer. Inflation is an important economic indicator because it affects the purchasing power of money and can have significant impacts on businesses, consumers, and policymakers. There are several types of inflation, including demand-pull inflation, cost-push inflation, and hyperinflation. Demand-pull inflation occurs when the demand for goods and services exceeds the supply, leading to higher prices. Cost-push inflation occurs when the cost of production increases, leading to higher prices for goods and services. Hyperinflation is a particularly severe form of inflation that occurs when prices increase rapidly and uncontrollably, often due to a collapse in the value of a country's currency. Inflation can have both positive and negative impacts on the economy. On the one hand, moderate inflation can encourage economic growth by stimulating investment and consumption. On the other hand, high inflation can reduce the purchasing power of money, discourage investment, and lead to economic instability. Central banks and governments often use monetary and fiscal policies to control inflation. Monetary policies involve adjusting interest rates and the money supply to influence the level of inflation, while fiscal policies involve changes in government spending and taxation. The goal of these policies is usually to maintain price stability and promote economic growth. Inflation can also have a significant impact on individuals and households. For example, inflation can erode the value of savings and investments over time, making it more difficult for individuals to achieve their financial goals. It can also lead to higher borrowing costs, as lenders may raise interest rates to compensate for the higher inflation risk. Inflation can also affect different groups of people in different ways. For example, low-income households may be more affected by inflation than high-income households because they tend to spend a larger proportion of their income on basic necessities like food and housing, which may be subject to higher inflation rates. Similarly, retirees on fixed incomes may be particularly vulnerable to inflation because their income may not keep pace with rising prices. There are several factors that can contribute to inflation, including changes in the money supply, shifts in supply and demand, and changes in the cost of production. Inflation can also be influenced by global factors, such as changes in commodity prices and exchange rates. Measuring and predicting inflation can be a complex task, and economists use a variety of models and techniques to analyze inflation trends. Some common measures of inflation include the CPI, the Producer Price Index, PPI, and the Personal Consumption Expenditures, PCE, Price Index. In recent years, inflation has been a topic of increasing concern for many policymakers and economists. In particular, the COVID-19 pandemic has led to disruptions in global supply chains and changes in consumer behavior, which have contributed to rising prices in some sectors. As a result, many central banks and governments are closely monitoring inflation trends and considering policy options to address any potential risks to the economy. How can we survive from inflation? There are several strategies that individuals and households can use to help manage the effects of inflation and protect their finances. Invest in assets that can keep pace with inflation. Some types of assets, such as stocks, real estate, and commodities, may have returns that are more closely linked to inflation. By investing in these assets, individuals may be able to preserve their purchasing power over time. Diversify your portfolio. Holding a diversified portfolio of assets can help reduce the risk of losses due to inflation. By spreading investments across different types of assets, individuals can protect themselves from inflation risks that may be specific to one asset class. Consider inflation-protected securities. Some types of government bonds, such as TIPS, Treasury inflation-protected securities, are designed to protect against inflation by adjusting their value based on changes in the CPI. Increase income sources. Increasing income sources through additional jobs or investments can help mitigate the effects of inflation on individual income. Reduce debt. High levels of debt can be particularly problematic during periods of inflation, as the real value of debt increases over time. By reducing debt levels, individuals can reduce their exposure to inflation risk, Reducing expenses, particularly on non-essential items, can help free up more money for necessary expenses that may be subject to inflation. Seek professional advice. Working with a financial advisor or other professional can help individuals develop a comprehensive plan to manage inflation risks and protect their finances over time. It is important to note that no strategy can completely eliminate the effects of inflation. However, by taking a proactive approach and implementing a range of strategies, individuals can help mitigate the effects of inflation on their finances and increase their long-term financial resilience.